As we have already looked into evolution of money and the banking system of the economy, it's time for us to now understand how important it is for the government to plan country finances. This chapter, Government Budget, talks about the various sources of government revenue and various expenditure to be incurred by the government. A government budget proposed by Finance Minister gives an impression about expenses to be incurred and revenue to be earned during a financial year. This means there are two main components of budget: the expenditure side or the expenses and the revenue. The expenses include all the expenditure to be made by the government during the financial year on the basis of the previous year's performance, expenses such as on infrastructure, public services, etc. Whereas revenue includes the possible sources of government income to finance the upcoming expenses, revenue from taxes such as indirect taxes, direct taxes, and many other sources. Budget can be interpreted in three different forms. If the estimated expenditure is exactly equal to estimated revenue, the budget is said to be balanced, that is, the income earned is exactly equal to expenses incurred. The second case talks about if the estimated revenue is greater than the estimated expenditure, then the budget is said to be in surplus, implying more income earned than the expenses to be financed. The third case talks about when the estimated revenue is less than the estimated expenditure, the budget is said to be in deficit, implying a situation when the government needs to earn more income to finance the expenses. Deficit budget refers to a situation wherein more funds are needed to finance the estimated expenditure. In such cases, the government borrows funds from outside sources such as IMF, World Bank, etc. As per the latest statistics, the country's second quarter fiscal deficit is $16.40 billion, which means government needs more funds to finance its expenditure. Since 2009, or maybe much before that, the Indian economy has been into huge fiscal deficit. So it's high time for the government to plan its finances in order to overcome the problem of fiscal deficit. Government budget receipts can be classified into two major categories. The first one is revenue receipts and the second one is the capital receipts. The revenue receipts can be further classified into tax receipts as well as non-tax receipts. The revenue receipts acts as an addition to government's income and not creating any liability for the government. Revenue receipts are earned in the form of tax receipts. The taxes can be further classified into direct taxes as well as indirect taxes. The direct taxes are those taxes which a person cannot pass on to others, such as personal income tax. Indirect taxes are those taxes which can be easily passed on to others, such as sales tax, etc. Income from all other sources, such as return on investment like dividend, interest, is termed as non-tax receipts. Capital receipts are basically those receipts which increase the liability or reduce the assets of the government. For example, in the first case, if the government borrows funds, it increases the liability of the government since the government has to repay the loan amount. In the second case, the selling of share decreases the government assets, so it's a part of capital receipts. Thank you.